Do you guys only work with the majors?
No, we vet banks. So we've probably investigated 1,500 different banks. Now keep in mind, there's probably 12,000 in this country. So we have a team. That's what they do 8 hours a day is investigate and research banks. And it changes. You know, what a bank was really good for us last year changed this year. Their guidelines change or risk tolerances change, et cetera. So it's constantly evolving. Out of those, let's say 1,500, we've identified about 200 that we really like to work with. And so a separate team, mainly Matt, looks at balance sheet. It's very easy to read a balance sheet on a bank and see if they're healthy or not healthy. If they have, let's say a 15-to-1 ratio on loans versus deposits, not healthy. So believe it or not, our favorites are the smaller community banks and credit unions. For multiple reasons, not just health. And don't get me wrong, the big banks are extremely healthy. But you have to have that balancing act of healthy and a good consumer-friendly product. Chase does not have to have a consumer-friendly product. Bank of America does not have to have a consumer-friendly product. U.S. Bank does not have to have a consumer-friendly product, because if you bank with, let's say, Bank of America, who's your first call to get a home equity line of credit? Bank of America. Their HELOC is terrible. Don't get me wrong, it's better than a mortgage, but it's in the HELOC world, they're so different. So and here's something else that you need to understand. In the mortgage world, I don't care if you're in New York, Florida, or California. An FHA loan is an FHA loan, a VA is a VA, a Fannie is a Fannie, a Freddie is a Freddie, a USDA is a USDA. The government has now controlled roughly 98% of the mortgage market. There's not even a difference in interest rates. You might have, at most, a 0.25% difference from one lender to the next. The only thing that differentiates the lenders is service. That's it. Service.
Is what? Say it again.
Service. So you remember during the subprime days, all the lenders were different. You could fog up a mirror and get a loan with some companies. Some other ones you couldn't. They had what we called ninja loans: no income, no job, no assets, and you still got a loan. So it was extremely different from lender to lender. That is the way HELOCs are to this day, because the government doesn't control that. That sits on the bank's balance sheet. So you will have a relationship with the bank.